Let me introduce myself. I am CA Parvesh Aghi. I completed my CA in 1985 and I am working as a visiting faculty with the Institute of Chartered Accountants of India and many management institutes and universities in Delhi and NCR. In today's lecture, we will be covering income from house property. This is your CA Intermediate course, paper 4, taxation, and I am CA Parvesh Aghi, your professor for this lecture. So let's do question number 2. Mrs. Rohini Ravi, a citizen of USA, is a resident and ordinary resident in India during the financial year 2017-18. She owns a house property at Los Angeles, USA, which is used as her residence. The annual value of the house is $20,000. The value of $1 may be taken as rupees 60. She took ownership and possession of a flat in Chennai on 1st of July 2017, which is used for self-occupation while she is in India. The flat was used by her for 7 months, only during the year ended 31st of March 2018. The municipal valuation is rupees 32,000 per month and the fair rent is rupees 4,20,000 per annum. She paid the following to the Corporation of Chennai: property tax rupees 16,200, sewerage tax rupees 1,800. She had taken a loan from Standard Chartered Bank for purchasing this flat. Interest on loan was as under. Now, period prior to 1st of April 2017, rupees 49,200. From 1st of April 2017 to 30th of June 2017, rupees 50,800. From 1st of July 2017 to 30th of June 2018, rupees 1,31,300. She had a house property in Bangalore which was sold in March 2014. In respect of this house, she received arrears of rent of rupees 60,000 in March 2018. This amount has not been charged to tax earlier. Compute the income chargeable from house property of Mrs. Rohini Ravi for the assessment year 2018-19, exercising the most beneficial option available. Now, Mrs. Rohini Ravi is a resident and ordinary resident in India. Her global income would form part of her total income. Income earned in India as well as outside India will form part of her total income. Now, in the question it is given that she possesses a self-occupied house at Los Angeles and there is a house also in Chennai. At her option, one house can be treated as self-occupied, whose annual value will be taken as nil. The other self-occupied house property will be treated as deemed let-out property, and the provisions with regard to deemed let-out property are explained now. So now let's understand the provisions relating to deemed to be let-out property, which is under section 23 subsection 4. Now, where the assessee owns more than one property for self-occupation, then the income from any such property at the option of the assessee shall be computed under self-occupied property category and its annual value will be nil. The other self-occupied property shall be treated as deemed to let out property. This option can be changed year after year in a manner beneficial to the assessee. In case of deemed let-out property, the expected rent shall be taken as gross annual value. If there are any municipal taxes which have been actually paid by the owner, the municipal taxes actually paid by the owner during the previous year in respect of the deemed let-out properties can be claimed as deduction. Now, the annual value of the Los Angeles house is rupees 12 lakhs. Because in the question it is given that it is $20,000 and the rate of the dollar has been given 60, so it works out to rupees 12 lakhs. So the annual value of Los Angeles house is 12 lakhs and Chennai flat is rupees 3 lakh 15,000. Now the annual value of Los Angeles house is more. It will be beneficial for her to opt for choosing the same as self-occupied. The Chennai house will therefore be treated as a deemed to let out property. First, we'll find out the interest on borrowed capital. We must understand that interest payable on borrowed capital for the period prior to the previous year in which the property has been acquired or constructed, which is called the pre-construction interest, can be claimed as deduction over a period of 5 years in equal installments, which commences from the year of acquisition or completion of construction. So she will be allowed a deduction on account of interest, including 1/5 of the accumulated interest of pre-construction period, and the details are as follows. Interest for the current year, which is rupees 50,000 plus 1,31,300, which comes to 1,82,100. Now here we'll add 1/5 of the pre-construction interest. Now the interest which is given as rupees 49,200, and we'll make it 1/5 of that, so 9,840 will be allowed to her. So the interest on the borrowed capital which is allowable will be amounting to 1,91,940. Now let us calculate the income from house property of Mrs. Rohini Ravi. Now first we will be taking the self-occupied house at Los Angeles. Here the annual value will be taken as nil and there will be no deduction allowed under section 24. So chargeable income from this property will be nil. The second house at Chennai will be treated as deemed let out house property. So the annual value here will be the higher of the municipal value and the fair rent. Now the rent is 4,20,000 for the whole year. So we will be taking for 9 months because she took the ownership and possession of the flat in Chennai on 1st of July 2017. So here we should remember that no adjustment is necessary on account of property remaining vacant. So 3,15,000 will be the income from the house property on account of deemed to let out house property at Chennai. So the total income here will be 3,15,000. Now she will be allowed municipal taxes reduction on account of the property tax plus the sewerage charges, which comes to rupees 18,000. So the net annual value would be taken as 2,97,000. Now she will be allowed deductions under section 24. 30% of the net annual value will be 89,100. Now she will be allowed for the deduction on account of interest on borrowed capital, which we have computed earlier. So that will be 1,91,940. So total deductions will come to 2,81,040 rupees. So that the income from deemed let out property will be 15,960. She has received arrears in respect of Bangalore property, which is chargeable to tax under section 25A. So amount of rent received is 60,000 rupees. Now she will be allowed a deduction at the rate of 30% under section 25A subsection 2, which will be 18,000. That means 42,000 will be treated as chargeable under section 25A. So the income chargeable under the head income from house property will be 57,960. You all enjoyed the lecture as much as I did presenting for you. Do add your comments as it is very encouraging and motivating. Please do like and do subscribe. Thank you.